What's up, guys? Welcome to Stock Talk with Nico Criticos. Today, we're going to be taking a look at Chipotle stock, ticker CMG, and we're going to do some stock analysis to find out why this is a good or bad investment at the moment. So, first thing on our list here, we're going to look at the stock chart, and we're going to find that it is up 370% in the last 5 years, and this stock is close to $1,500 a share now. The market cap on this company is $41 billion, and the price to earnings is 46 times. So taking that into consideration, today I decided to buy my first share, and we're going to go through all the things in my checklist to find out why I am bullish. So the first two things are revenue and net income. If we look at revenue over the last couple decades, over the last decade, they've averaged 12% revenue growth per year. And for net income, they've managed to average 12% net income growth as well. So both of those are good numbers. They've consistently grown revenue and net income. Those will both get a check. Now, as for number three, this one is more debatable because a lot of people are going to tell you that 45 times earnings is way too expensive, or even on a forward basis, it's 35 times earnings, which is still considered expensive for a lot of companies, especially a company like Chipotle that's growing at 12% per year. So, for example, Tesla and some of these other software companies trade at similar valuations, and they're growing at 30% or 40%. So why would you buy Chipotle if it's only growing at 12% per year on average, and it's trading at a 35, 45 times earnings? Well, the interesting thing here is that if you go ahead and look at the past, between 2017 to now, this stock has traded pretty much 45 times, 43 times earnings is the cheapest it's traded. And then same thing with the numbers before. We look at, I like taking out the outliers of this graph. So let's see, if we pull this back a little bit, we're going to see it's traded down to 35 times, 31 times back in 2015, 2016. So, but really, in the more recent past, this stock trades at 45 to, let's say, 100 times earnings, something like that. So a 65 or a 70 is really the average. That's why I feel like on a forward basis, 35 times earnings or even 45 times earnings, I understand that's a risk going into this, but for the Chipotle has such a strong brand, and I just think that this could be one of those companies like Amazon or Shopify or Tesla. There are certain companies out there that trade at higher valuations than most companies. Amazon always trades at 40, 50, 60, 70 times earnings. You're not going to buy Amazon for 15 or 20 times earnings. That's not going to happen, and at least not anytime soon, and not anytime in the last 20 years when was a good chance to buy the stock. So I think Chipotle has a good chance at being a company like that. If I'm wrong, then yeah, Chipotle could come back down to, who knows, $800, $900 a share, and the stock gets cut in half or something, and I lose half my money. I think that I have a pretty good chance, though, at having this company continue to run up, and maybe it stays at 50 times earnings. I think there's a good chance of that. So I'm taking my chances with that one. But the bottom line is 45 times earnings is lower than the average, and it's trading at 29 times earnings for 2024. So it's pretty much the lowest it gets. So I think I don't know. I'll take my chances with that one. We'll see what happens. Are they innovative? Do they have a moat? Well, are they innovative? I don't know about that. They're just making burritos. I mean, they're fast food. They're casual food. You can, walk in and out pretty quickly. But their moat is they have a very loyal customer base. Chipotle is always busy. There's always people going there. I go there all the time. I love the burritos. So I would consider that a moat because there's not that many restaurants out there that are like fast food like that are somewhat healthy. It's healthier than most other restaurants, and has a consistent customer base like that. Is the industry growing? Yes. Restaurants, fast food, drive-thrus, all that stuff, healthy eating, those sectors are growing. Respectable return on invested capital. Yes. If we take a look here, we are going to find that they did 20% ROI last year, which is phenomenal. And then during COVID, they did 6%. But before they had their E. coli outbreak in 2016, they were doing 30% ROI. That's huge. That not many companies can do that. Like big software companies can't even do that. So that's a very good sign. Healthy cash flow. Yes. If we take a look at cash flow here, I like to look at, you got to look at free cash flow, and you got to look to see if they're growing free cash flow and that they're not investing anything crazy. So free cash flow, it's good. It's gone from 387 million to 2019 to the trailing 12 months of 844 million. That's more than a double up in 3 or 4 years. So that's good. That's really what we're looking for there. And they're investing, I mean, they're investing some money, but it's nothing crazy. And they're opening new restaurants. I forgot what the number is, but I don't know if it's 10 restaurants a year, 20 restaurants a year, something like that. But they're opening new restaurants and they're still growing. Diverse revenue streams, I put no, it's just burritos, tacos, bowls, quesadillas, and that's pretty much it. I wouldn't really call that a diverse streams of revenue. Growing equity, yes. If we want to take a look at their equity here, what we will find is that it's gone from 1.6 billion 4 years ago, or 3 years ago, really, to 2.3 billion. So that will get a check. Is the equity over 15%? No. This leads back to the valuation problem, because they only have $2 billion of equity, but you're paying 41 billion. That is expensive. Once again, that is expensive. So that's the major risk with this company. Share count decrease. Let's see here. Share count decrease. Shares outstanding, nothing crazy, but they're taking shares off the market slowly but steadily. So that will get a check. Healthy amount of debt, I put no, because if we take a look at the most recent balance sheet, I like to compare current assets. How much do they have in cash and receivables? 1.1 billion. With that 1.1 billion, are they going to be able to pay off their $4.5 billion of liabilities? Well, that could take a couple of years. So although they can pay off their current liabilities, which is very good, but in long-term debt and capital lease, which means the money that's going to all those buildings that they're building the restaurants at, that's where that long-term debt's coming in. And really, that's not that big of a problem. As long as they can take care of their short-term liabilities, they are going to need to make, a couple $1 billion extra to pay back those capital leases. And what are they doing? They're averaging 900 million. So I think it'll balance out. Really, that one could get a yes, to be honest. Healthy, I would say this could be considered a yes. Respectable management, yes. Besides for the E. coli outbreak of 2016, everything, return on invested capital is incredibly strong, so that's going to get a check. The stock price is up huge. That makes management look good. Current assets more than average annual income, yes. We just saw 1 billion in current assets, and then under 900 million in last year's income. No dividend. And the company is over 20 years old. It was founded in 1993. So altogether, this will get we don't have many no's on here. We only have 1, 2, 3. So this is going to get a 13 out of 16, which is considered a buy. So all in all, I would say, I think most people like Chipotle's food. They have a very strong customer base. They have a very good business model. Their food is healthier than most other restaurants. I don't think they have a problem there. They're growing revenue and net income at an average of 12% per year. That's also very strong. It's not incredibly crazy like something that should be trading at 40, 50 times earnings, but it is what it is. Sometimes companies like Costco trades at 35, 40 times earnings, and they're not growing anything crazy either. But it's just because when you have certain businesses, or like Nike is another example, Disney, Starbucks, some of these companies that just have really strong brand names, there's a certain moat and competitive advantage that comes with those companies that you don't get from any just startup company or any competitor, or any stock that tries to compete with that. It's not always that simple. There's the customer loyalty and the strength of the brand name you're gonna pay for that in the premium. That's what adds to that premium, is that you're buying. It's hard to replicate a Disney or a Starbucks. You can't just come out and just copy that overnight. So I think that's where the premium comes from for this company. Realistically, this company could be trading at 20 times earnings or 25 times earnings. So there is that risk that things come back to reality. If growth ends for this company and they can't seem to grow, or their profit margins get hurt really bad for some reason, then yeah, this stock can come down, who knows, at least 30, 40, 50%. That's a risk I'm willing to take, though, solely based off the fact that Chipotle, how I said, good company, all the financials are strong, that ROI is super strong, the brand name is super strong. The major risk, though, is, I guess you're taking the risk because of the valuation, but the reason I'm looking past that is because over the last however many years, 6 years, 8 years, however much you want to look back, that PE ratio goes up to 100. It went up to 150. It averages from 60 to 70, and I'm paying 45 right now, and I'm paying 35 or 30 on a forward basis for next year. So I think I have a pretty good chance of being on the right side of things and having this company turn out to be a company like Amazon, who has such a strong brand name, such a strong business model, that they demand that extra premium on top of their stock, and the stock never trades down to a 15 times earnings. Amazon doesn't trade down to a 15 times earnings. I don't think Tesla will either anytime soon either. I think Tesla, you're going to pay at least 35, 45 times forward earnings. So that's the way I look at it. I think this has a pretty good chance of being one of those type of companies. If not, and I'm wrong, then I'll take the loss on it. I'm not putting my entire portfolio into the stock. It's just, you know, a couple percent, 1 or 2%. So that's it. That's my bottom line for this company. But overall, I would say I'm pretty bullish on this stock. And yeah, thank you for watching, and I will see you guys in the next video.